Okay, under current liabilities management, we want to look at three important things. One is how do you manage your accounts payable. The second is how do you manage your accruals. When you say accruals, we are talking about other type of payables such as wage payable, salary payable, etc. The third thing is how do you manage your short-term borrowing. Okay, let's start with accounts payable management. Okay, when you say accounts payable management, it involves how are you going to pay your supplier. Okay, when you purchase something from your supplier, the supplier is going to offer you certain credit terms. Okay, under the credit terms, you might be given a cash discount as well. Okay, one of the important decisions that you're going to take is whether to take up this cash discount or give up this cash discount. Okay, let's consider an example here. Okay, let's say that you have purchased something worth of 1000 and the customer or the supplier has given you a credit term which is 2/10 net 45, which means that you can avail 2% discount on the 1000 if you pay within 10 days. Okay, and if not, you have to pay within 45 days. Okay, from the day of purchase. So that is a credit term which is being offered. Okay, if you take up the cash discount, then you have to pay 980 rupees in 10 days. Okay, or you have to pay 1000 rupees. Okay, so it is either you pay 980 if you pay within 10 days, or you'll be paying 1000 rupees. Okay, now let's say that you don't pay the 980 rupees. Okay, you're going to pay the 1000 rupees on the 45th day. Okay, which effectively means that, okay, instead of paying 980 within the first 10 days, you are paying 20 rupees extra, okay, for using this 980 for the next 35 days. Okay, within 10 days you have to pay 980, but you're not paying it. Okay, so you're going to use this 980 for 35 more days, but you have to pay 1000 rupees to your supplier, which effectively means that you are paying 20 extra for using the 980 rupees for another 35 days. Okay, now we are going to calculate what is the interest for interest rate of this 20 rupees on 980 rupees. Okay, so the cost of using 980 for another 20 day is 20 divided by 980, okay, into 365 divided by 35. Okay, why we are doing this is you are paying 20 rupees as interest for using this 980 rupees for 35 days. Okay, so for one day the interest would be 20 divided by 980 divided by 35, and when you need the interest rate for the year, you are multiplying that by 365. So the interest rate is 21.28. Okay, so 21.28 is the interest that you're paying for using the 980 for another 35 days. Okay, the simple formula to calculate the cost is cash discount divided by 100% minus a cash discount into 365 divided by the number of days the payment can be delayed. Okay, this is this formula is what we have used here to calculate this 21%.28. Okay, if you look at that, the cash discount was 2% divided by 100 minus 2, which is 98%, into 365 divided by the number of days the payment can be delayed further is another 35 days. If you don't pay within 10 days, you can take another 35 days to pay the 1000 rupees. Okay, so this is the formula for you to calculate the cost of giving up on your cash discount. So the cost of giving up on the cash discount here is 21.28%. This is a cost that you are incurring for giving up the cash discount. Now to know whether it is okay or not, you are going to compare this 21.28% with the cost that is available to you for raising funds from external source. Okay, if an external source is offering you financing at 15%, okay, then probably you can go for that instead of giving up the cash discount. Or if, for example, if the external source is offering you at the cost of 25%, okay, so instead of going for the external fund, you can give up the cash discount and use the amount for the next 35 days here. Okay, that is how you will know whether to give up the cash discount or. Next we'll look at approvals. Accruals are nothing but the liabilities that arise when services were received and the payments are yet to be made. Okay, for example, someone has worked for you and you are supposed to pay wage for them, and if you are yet to pay the wages, and that becomes an accrual. Okay, let's now look at an example here. You are supposed to pay rupees 10,000 at the end of every month to your employees. Okay, so which means that in a year you would be paying 12 times this 10,000 rupees to your employees. Okay, now if you decide to delay this payment by a week, so instead of paying at the end of the month, you are paying on the first week of the next month. Okay, so what effectively happens is that in a year, instead of paying 12 times, you would have paid only 11 times. Okay, the final December at the end of December month, you would not have paid, you would have only paid it in the next year. So until December, if you consider until the end of December, you would have paid only 11 times. Okay, so which effectively means that the whole all through the year you have had 10,000 with you. Okay, which you are supposed to pay as wages, but you have delayed that payment by a week. Okay, because of delaying it by a week, you had this 10,000 for the whole year. Okay, now if you consider the cost of borrowing, let's say it was 10 percentage, which means that effectively to borrow 10,000 rupees you would have paid an interest of 1,000 rupees. Okay, now by delaying this wage payment, you have instead of borrowing, you can use your own cash of 10,000 rupees, which effectively means that you are saving 1,000 rupees by delaying the payments. Okay, this is how you can manage your accruals. Okay, next we are looking at short-term financing. Okay, short-term financing can be unsecured or secured. First, let's start with unsecured for short-term financing that are available. Okay, the first thing is bank loans. You can raise short-term finances through bank loans. Okay, bank loans can come with different conditions. Okay, the conditions could be interest to be paid at maturity, or the interest is paid in advance. When the interest is paid in advance, it is also called as discount loans. Okay, let's look at an example. Okay, let's say that you have borrowed 1,000 rupees for 1 year at 10 percentage. Okay, if the interest is paid to be paid at maturity, then you have to pay the 10% on this 1,000 at the end of 1 year. Okay, so the actual interest rate would be 10 percentage. Okay, the actual interest rate would only be 10 percentage because you are paying it only at the end of maturity. Okay, but if the interest was to be paid in advance, which means that immediately you borrow 1,000 rupees, you have to pay 10% interest on it. 10% interest is nothing but 100 rupees. Okay, so as soon as you borrow, you are paying 100, which effectively means that you are left with only 9,900 rupees of the borrowed amount. Okay, so which means that you are paying 100 rupees interest on 9,900. So the effective interest rate would be 100 divided by 9,900, which is 10.1 percentage. Okay, so depending on whether you pay at maturity or in advance, their effective the second type of unsecured loans is line of credit. Okay, line of credit is nothing but it's a facility offered by the banks. Okay, whereby the companies can borrow as and when required up to certain limit. Okay, an important aspect of this line of credit is that okay, the bank does not give a guarantee that it can at any time the company wants, it will be able to lend. Okay, let's say for example the bank offers a line of credit of let's say 4 lakhs. Okay, the company can borrow to an extent of 4 lakhs from the bank. Okay, but it is not mandatory for the bank to lend the money when it does not have enough money to lend. Okay, another important aspect of the line of credit is what you call as compensating balance. Okay, compensating balance is nothing but okay the amount which the company always has to maintain with the bank. Okay, now let's take an example here. Let's say the line of credit of 25,000 rupees is offered at 10% interest rate. Okay, if the compensating balance is 20%, then it means that 20% of this to 25,000 should always be in the bank's account. Okay, which 20% of this 25,000 is 5,000 rupees, which means that the 5,000 rupees of the line of credit should always be in the bank's account, which means that the company can effectively use only 20,000 rupees. Okay, but when it pays the interest, the interest would be paid for the interest of 10% would be paid on the 25,000 rupees. Okay, so the effective interest rate is, it is paying interest of 2,500, but it can use only 20,000 rupees. So 2,500 by 20,000, which is equal to 12.5 percentage. So the interest rate is not actually 10 percentage, but it is 12.5 percentage. Okay, this is the second type of unsecured loan. The third type is what we call as revolving credit agreements. Okay, revolving credit agreements are similar to the line of credit. Okay, the only or the major difference is that the bank guarantees the amount that has been accepted for the company to borrow. For example, if the credit agreement is for 4 lakhs, okay, the bank will ensure that at any point in time, irrespective of whether the bank has enough funds or not, it will give, it will lend up to 4 lakhs. Okay, the another characteristics of this revolving credit agreement is that there will be a commitment fee on your unused fund. Okay, for example, let's say that there was a line of credit for 1 lakh. Okay, the line of credit for 1 lakh at 10 percentage, and commitment fee of charged for 1 percentage. Okay, now of this 1 lakh, let's say that you have used only 80,000 rupees. Okay, the bank, the interest that you have to pay is 10% on the 80,000 rupees, and also 1% of the commitment fee on the 20,000 rupees which you have not used. Okay, so effectively you will be paying 8,200 rupees. Okay, so I'll repeat this again. You have been given a line of credit of 1 lakh. Okay, and the interest is 10 percentage. There's a commitment fee of 1 percentage, which means that if you don't use any funds of this 1 lakh, and 1% charge will be charged on the amount that was unused. Okay, so for example, if you have used only 80,000 rupees, okay, you will pay an interest of 10% into this 80,000 rupees, which is 8,000, plus and 1% on the extra 20,000 which you have not used. So totally you will be paying 8,200. So your net effective interest rate will be 8,200 divided by 80,000, which is 10.25 percentage. Okay, and the final type of unsecured financing is commercial paper. Commercial papers are nothing but it's a promissory note, okay, whereby a company promises to pay certain amount after certain period. Okay, let's say there is a company issues a promissory note of paying 1,000 rupees after 30 days. Okay, this the company can sell this commercial paper to the public or any other institutions to raise money. Okay, when it sells this commercial paper, okay, generally it sells at a discount. Okay, let's say that the company promises to pay 10,000 rupees after 90 days, and generally these commercial papers are generally sold at a discount. Okay, 90 days and sell the paper at 9,800. Okay, so it is the commercial paper is being sold at a discount of 200 rupees. Okay, so the effective interest rate on this commercial paper is that it is the company is paying extra 200 for using 9,800. Okay, and this 9,800 is being used for 90 days. Okay, so the interest rate for the 90 days would be 2.04 percentage for the 90 days. Okay, so these are the different sources of unsecured loans that a company can use. Next, we are going to look at some secured forms of short-term financing. The first thing is using account receivable as collateral. A company which has certain amount of account receivable can use the account receivable as collateral, and it can ask a lender to lend money based on that. A lender which is going to use account receivable as collateral will classify the account receivable based on the quality of the account receivable. It would look at what are the ages of the account receivable in the account of the company. Some account receivables would be of 30 days, some could be of 40, or some could be of more than 40. Okay, so based on the criteria of the lender, it will choose a part of this account receivable. Let's say that it chooses 800 rupees of the 1000 rupees as a good quality account receivable. So the lender will use this 800 as collateral, and it will lend money as a percentage of this 800 to the company. Okay, in this process there is something called as notification. Notification is when the lender notifies the customer that his account receivable has been considered as a collateral. If that is the case, then the customer might directly pay the lender instead of paying the company. Okay, if it is a non-notification basis, then the lender will not notify the customer will be paying the company, and the company will in turn pay back the lender who has lent money using account receivables as a collateral. Okay, so that is one form of secured. The second form of secured short-term financing is factoring your account receivable. Factoring generally means that selling your account receivable at a discount to another company. For example, a company has an account receivable of 100 and it wishes to sell this account receivable to another company for 90. Okay, this process is called as factoring. Okay, so the company which is buying the account receivable at a discount is called as the factor. Okay, the advantage of the factor for the factor is that now it is paying 90 rupees to the company and buying the account receivable. Okay, so now the customer has to pay the factor instead of the company. Okay, so the factor would receive 100 in place of 90 rupees that it has paid to the company. Okay, so the factor can pay the 90 rupees either when the company, or sorry, the customer pays the factor the 100 rupees, or the factor can pay this 90 rupees when the customer's credit period ends. Okay, so for example, let's take that a customer has to pay this 100 rupees in 20 days. Okay, so the factor can pay the agreed upon 90 rupees to the company when the customer pays this 100 rupees anytime before the 20 days, or at the end of 20 days. So at the end of 20 days, even if the customer has not paid the factor should still pay 90 rupees to the company, which effectively means that the company does not have any risk of the customer defaulting. Now that risk has been shifted to the factor. Okay, so this is the advantage of for a company when it factors the accounts receivable. Okay. The third form of collateral, the third form of secured financing is using inventory as a collateral. Under this, you have three different types. One is floating leads, where an inventory which does not have too much of which is not very expensive. Okay, that are being used as collateral, and on that a lender would lend money. Generally, a lender could lend only 40 to 50% of the collateral value to the company. Okay, the second type is trust receipt loans, where the lender will take into account the expensive items that a company will have under its inventory, and it will use that as a collateral, and it would lend up to 80 to 90% of the inventory value to the company. The third type is warehouse receipt loans, where the lender will take control of the inventory from the company. In the previous two cases, the inventory will still be with the control of the inventory will still be with the company. It can choose to sell the inventory or that. But in the third case, in warehouse receipt loans, the lender takes the control of the inventory. So the lender will decide if it wants to sell the inventory or not. Okay, so these are the different types of secured financing that a company can go for.